Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hello, everyone. Welcome to the latest episode of Carson's Facts versus Feelings. This is sponsored by our friends at YChart. Sonu, this is episode 63. We're titling it Things You Don't See in a Recession. Now, I have a little story, Sonu, if I can start with this. I don't know if, holiday lights, Christmas lights on your house signal a recession or not, but there's a lot of them in our neighborhood. A couple days ago, I guess it was Sunday, so we're recording this, on Tuesday. So on Sunday, I was putting a lot of my lights up. I always have a lot of lights, and it looks pretty good. I was doing something I've done for 15 years, and all of a sudden, one of my lights exploded and popped and shocked the you-know-what out of me. My dog was out with me. I talk about Mabel, my new dog. Anyway, she's out running around playing with me. And I honest to God, for half a second, thought I died. It scared me to death. I look at the dog and I go, am I alive? And she just looked at me and didn't say anything. I was like, good. If she's talking back to me, I figured I was dead. So the fact she didn't talk back, but it was pretty scary for a second. I know you can't see it. I've got a black mark on my thumb where I just touched a light and the light broke and just shocked the you-know-what out of me. It was something. This has never happened before.
Snowing?
Yeah, it was rain, lightning. I was out. No, I was not. No, I was not. I'm not that stupid, Sonu, to put lights up with rain. Look, give me a little credit. We've done 63 of these. I mean, come on. Anyway, no, it was a fairly nice day in Cincinnati on Sunday. So I don't know. Do you do the holiday Christmas lights thing? Do you put them on your house? How do you do it there in Chicago?
We do the tree usually the week before Thanksgiving, but we were out this Thanksgiving, so it was a weekend. After Thanksgiving, they put the tree up, and I haven't quite put. I haven't had. We don't have a big yard, so to speak. It's just a little one. And my wife keeps telling me that, you should get lights. You should get lights. I still haven't got around to jumping on my phone, getting on Amazon, ordering lights. Maybe internally I know that, I have to figure out how to do it. And, now you've scared me even more.
I was going to say, does she listen to this? If she'll listen to this, she'll say, you know what? We don't need to go that route. But all right, let's jump into it. Lots of stuff to talk about. Again, this week is sponsored by our friends at YCharts. We're going to take a look at stocks in the beginning. The rally continues. We're going to remember a titan. I wouldn't say on Wall Street. Charlie Munger probably would not want to be known as someone on Wall Street. We're talking about Charlie Munger, the impact he's had on his, this industry, on us. We've got a lot of cool quotes and a couple stories I want to talk about here to honor the great Charlie Munger. And then lastly, kind of the title of this, again, is what things you don't see in a recession. We're going to take a look at the macro backdrop and some things that just simply continue to say, at least to us, we don't see a recession. All right, so let's start with stocks. I know I've got some notes here. Right. S&P up 8.9% last month. One of the best months we've ever seen. Now, here's what I want to bring you in on. So stocks did great. Okay, that's great. We've been bullish. We've been talking about it. We thought late October lows. 60-40 portfolio. This is data from Bloomberg article. Up 7.3%. That's the ninth best ever. And according to Bloomberg, the best month for a 60-40 since 1991. And I know I've got the ag data here somewhere. Ag up 4.5% in November. The best month since, May of 85. According to this data source. Remember when they told us 60-40 was dead? I know that we actually started this conversation about stocks. Maybe we're going to do a little different. We'll talk about portfolios too. I guess 60-40 isn't dead yet, huh?
I guess not. I mean, it's, I was literally thinking the same thing when you were reading the 60-40 stats. I was like, the first thing that came to my head was so many people saying, the 60-40 is dead. They've been saying that for actually about a decade, and somehow the thing never dies, right? But the idea is, look, you want bonds to zig when stocks are zagging, and that's the whole idea. Over the last decade, both have gone up. Last year, both went down, so it hurt. Bonds didn't zig when stocks zagged. This year, bonds are actually, stocks went up, right? What, the S&P, Ryan, is up 21%?
Yeah, right. Total return more. Yeah, total return over 20. Yeah.
And in a classic situation, you want your diversifier, which are bonds, and you mentioned the AG, which is the aggregate bond index. It's supposed to go the other way, right? And it's still it's got a slightly positive return after last month's rally. I mean, part of me is like, what more could we want here? I mean,
Well, that's a good question. I mean, yeah, given how bad, again, a 60-40 portfolio, 60% stocks, 40% bonds, it's kind of just is benchmark the right word to use here that we kind of use in our industry of a well-diversified portfolio. Maybe there's some cash and some gold, different things, but 60-40, pretty standard. And again, last year was like the worst year, one of the worst years ever for 60-40s, one of the first years we've ever seen, according to data, go back to like the Civil War. I don't know how they do it, but they do. That stocks and bonds are both down double digits. Believe me, we've talked a ton about that. So at the end of the day, when we were bullish coming into this year, a year ago right now, we said one of the reasons to be bullish was because this year was so bad, this year being 2022. Right. You tend to get bounce backs, especially if you can avoid a recession, at least on the equity side of things. And that's exactly what we've seen. Now, a couple things also I want to point out here, Sonu. More than 60% of all the stocks in the S&P 500 made a 20-day high on Friday. So that's like a breadth thrust. We've talked a lot about this, like a lot of stocks participating, a lot of stocks going up. We heard for a long time, it's only 7 stocks. It's only 7 stocks. We disagreed with that, but we honestly wanted to see more participation from other stocks. Well, we're seeing it because we just saw more than 60% of all stocks make a 20-day high in the S&P on Friday. What in the world does that mean? What happened next? That's what we're going to talk about here on Facts versus Feelings. Here are some facts for you. And again, these are maybe things you don't see in a recession, a roaring stock market. Because 6 months later, S&P up 8.2%, higher 11 out of 15 times. I took the first signal after 6 months without one, because you can have clusters of signals. Sure. So it went a while without a signal. Here's the money stat, so to speak. This is data from our friends at Ned Davis Research, going back to 1972, by the way. 12 months after one of these breadth thrusts of more than 60% of the S&P 500 making a 20-day high, 12 months later, up 18% on average, higher, are you ready for this? Drum roll, please, 15 out of 15 times. Wow. There's a lot of other stats 100%. And figures. Yeah, we talk about it on this podcast a lot. Every week I continue to bring kind of these numbers and these ways to put context around it. But to me, that's just one more layer on why you should be a bull, brick in the bull house, whatever little lingo we want to use. And we're going to talk the macro backdrop here, the second half of this podcast, but just from the markets, the message of the market. Sonu, the strength we've just seen in November, early December is not a bear market rally. I'll just leave it at that. It's probably the kickoff to more strength. You want to build on that?
Are we still talking about a bear market rally? I mean,
I don't know. Some people do. I don't know. Yeah.
Sorry, I was choking myself when I said that. But but look, I think the stat you mentioned, 18%, right? 15 out of 15 times 1 year later. I think to put that in context, the average 1 year return is about 9%.
Yep, higher 7 out of 10 times, like 71% of the time.
Right, so 71% of the time markets are up. So you're always looking for, what are the odds relative to that, right?
Yep.
Because, you couldn't do much worse than, stocks have done well historically. I'm just going to bet on stocks, right? Why not? But then, we talk about 60-40 portfolio in our own portfolios. I think I can say it here. We are overweight equities. Why? Because we like the macro backdrop, and a lot of the work you do pays attention to exactly what you talked about. You want to pay attention to what markets are saying with respect to prices, right? And then you look at, wait a minute. Normal odds of the market going up, giving a 9% return is about 70%. And now you have something like this, and the odds are more in our favor for a higher return. So I like that.
Yeah. No, agreed. Here's another one for you. So the S&P gained 8.9% last month. That was the 18th best month ever. I went back and looked at the previous 20 best months ever, going back to 1950. What happened next? 1 year later, the S&P 500 up 80% of the time. So again, a little bit better than average, but up 13.3% on average. Again, the strength we've just seen, the breadth we've just seen with the macro backdrop we're going to talk about, with the Fed likely done hiking, which we've talked about before, and who knows, maybe we'll talk about it again before this podcast is over. There are just still reasons to think things are going to go higher. Final comment or concept we want to talk about, the idea of participation. We've mentioned on this very podcast for several months now, we have been overweight by a little bit, small caps and mid caps in the models we run for our Carson partners. And it has been painful. Parts of the third quarter were painful. But Sonu, all of a sudden, just since the end of October, we've seen a huge surge in small caps and mid caps. And honestly, the S&P 500, something called equal weight, right? There's 500 stocks in the S&P, although I think it's like 504, but we're just going to say 500 to keep this easy. Yeah. Yes, some of the big, super big stocks, the big tech names, communication names we all know and love and use every day, yes, they are a big part of that on the way up. But what we've seen lately, the equal weight S&P 500 has drastically outperformed the last five or 6 weeks approximately. The equal weight has outperformed the S&P 500. What in the world does that mean? Well, hey, the equal weight means all those stocks are worth the same. Okay, they have the same weighting is what I should say. And they're doing better. So that tells you more stocks are going up. What does that mean from an investment's point of view? Yeah, if you manage models and portfolios, what does that tell you if more stocks are going up?
I mean, it's participation, but you're always looking for corroborating signals, right? You look at the economy and say, okay, based on what the economic backdrop is, or what the macroeconomic backdrop is, including policy, all of that, we think this is what stocks are going to do. But you're also looking at, okay, what are stocks telling us? Sometimes, more often than not, I would say not all the time, but more often than not, stocks tend to lead the economy, right? Because I'm not saying investors get it right all the time, but they do for the most part. And so you want to pay attention to that. And then you see something like this, where there's more participation, literally, as you said. And when you're equal weighting the 500 stocks in the S&P 500 index, what you're doing is essentially, that's a proxy for mid-cap stocks. Yeah. That's really okay, that's what mid-cap stocks are going to look like when you track the returns and things like that. It's not quite small cap stock, but small and mid tend to do kind of the same thing. And it's more geared to the economy. Right, these stocks are more geared to interest rates. We talked about that. A lot of these smaller companies are floating rate debt. I think you had a nice chart a week or two ago about that. That I think Samro shared. So so all of that, the signal from the market tells you, what, things are getting better for small and mid caps, right? I think that's a huge positive.
Yeah, I think it's getting better now, but we think into next year, right? Some of those headwinds that were there for small and mid caps, we think are not there anymore, right? Potentially could be tailwinds. One final thing about things you usually don't see in a recession along the lines of equities. New all-time highs, right? The Dow on a total return basis, like literally earlier this week, or maybe I guess late last week, hit an all-time high. Now, again, that's considering dividends, right? So without dividends, we're a couple percent away. S&P's like 5% away. With dividends, like 2% away. But nonetheless, including dividends at an all-time high. When you look historically, yes, we can find a couple times where the market peaked and then things rolled over and things got bad. Believe me, I know they're there. But you know what happens, Sonu? Normally, when you have new highs, it's the market's way of sniffing out potentially, better times coming on the economy. Because again, the stock market tends to lead the economy. So again, that's just not something you tend to see if we're about to fall into recession. The other thing you don't tend to see is everybody flying. And I think we maybe talked about you flying to Jamaica on your trip last time. But honest to goodness, I don't necessarily remember it. But what we did see, TSA, 2.9 million travelers, according to TSA in airports on Sunday after Thanksgiving. And overnight, and over 90% of the flights are actually on time. As somebody who flies a lot, we all know what happens. You miss one flight, you get late. They're all late. They're all messed up. So congrats to everybody who helped get a lot of people to where they had to go over the holidays. What day did you fly back from Jamaica? Was it Sunday?
Friday. But I'm not saying I predicted the Sunday travel rush, but I think I knew better than to travel on Saturday and Sunday. I was like, I'm getting back home on Friday. I don't want to navigate O'Hare or whatever airport being stuck in Jamaica with as nice as it is.
There could be, my wife and I, for our 15th wedding anniversary a couple of years ago, this is when obviously COVID was really a big deal, a bigger deal. If you've tested positive, you had to stay. We were like in Dominican Republic at some amazing resort. I was like, I don't know if this is the worst thing in the world to have to stay at this resort. Like, I guess you got to pay for it and you got to find someone to watch your kids. But nonetheless, maybe I'm positive and okay, well, I'll see you in about a week. Take care. Anyway, that I was not positive and got to go home to my loving family and leave that wonderful.
There you go.
Anyway, but again, those are things you tend to not see in a recession. Stocks making new highs, 2.9 million people in one day traveling, an all-time record. All right, Sonu, let's talk about Charlie Munger. He passed away about a week or so ago. I believe his birthday was January 1st, or would have been January. Would have been 100 on January 1st.
Oh, really? Wow.
And he obviously was Warren Buffett's right-hand man in a lot of ways. He probably taught Warren Buffett so many things over the years. Carson Group is based in Omaha. Clearly, Charlie Munger and Warren Buffett in Omaha, so hits a little harder. Hits everybody hard, believe me. Just all the amazing things he's done, and obviously Warren Buffett have done. I've got some quotes and some stories. Do you want to talk a little bit about some things you've learned from him, or anything you want to talk about before I talk a little more?
I mean, I'll pick a quote and a story. Or investing lesson, if you may, more than anything else. Look, one of my favorite quotes of his is like, if you want formulas, go back to graduate school. They'll give you lots of formulas that don't work. Right?
Yeah.
And here's another one. He's asking about inflation. He's like, look, I'm optimistic about life when I'm nearly dead. Surely the rest of you can handle a little inflation, right? So
yeah.
There's a perspective. But look, I think one thing that's interesting, and I kind of knew this, but I didn't really internalize it until I was reading about, how they work together between, I guess, Munger and Buffett, right? So Buffett used to be all about buying companies really cheap, right? Like they have to be really cheap in terms of valuation, things like that, right? But Munger came in apparently and told Buffett, no, we should focus on buying wonderful businesses at a fair price, as opposed to a fair business at a wonderful price, right?
Oh.
And then the focus shifts on quality companies and the importance of brands. I mean, I'm going to say, a few companies, See's Candies, Coca-Cola, American Express. Buffett bought them all after, that partnership went strong over so many decades, right? And again, this is not a recommendation, by the way, to buy any of the stocks. But like Munger said, look, over the long term, it comes to how much companies are going to earn, right? If they earn 6% on capital over 40 years, doesn't matter how much you pay for it now. If you hold it for 40 years, you're not going to make something much different than a 6% return, even if you originally bought it as a big discount, right? So all this to say, we can get caught up in near-term, whipsaws, swings in the market, but having that long-term focus is important. And it doesn't matter exactly when you buy it, as long as you're buying strong quality companies. It also ties to economic growth and companies, right? Over the long term, look, Ryan, market returns come from earnings. Even if you just take the last 4 years, I was looking at the stat for the podcast. The S&P is up 51%.
Okay.
41% of it, 41 percentage points, came from earnings growth. 8% is dividends, so that's 49%. Only 2% came because valuation multiples went up, right? And where do earnings and profits come from? The economy. And that's literally why we focus so much on the macroeconomic backdrop. Profits come from the economy.
Wow. Great stuff there, for sure. So just a couple Mongerisms. I believe that's a word we've come up with in honor of Charles Thomas Munger. He said, what I really like, before I even get into this, what makes, I think, Charlie Munger and Warren Buffett and a lot of other greats, they are super smart. We get it. A lot of super smart people out there. But they can tell stories. They've got little smart quips. They've got little quotes. Who knows if you even really said half these quotes are getting attributed to. But the bottom line, they connect with people in a different way, right? And again, I always tell college students this, like, there's lots of smart people out there. But can you talk to someone and make them feel a certain way, make them think a certain way you're trying to make them think? And I mean, the way that I've done it in my career is to tell some stories, tell some jokes, and tell some quotes, and tell some stats, that find what works for you. But I'm just saying that's what I think matters. And here are some really, I don't know, I'll just read them. Awesome quotes from Charles Thomas Munger. If people weren't wrong so often, we wouldn't be so rich. I like that one. It's not supposed to be easy. Anyone who finds it easy is stupid. I like that one. Show me the incentive and I will show you the outcome.
I like that.
Someone will always be richer and faster than you. That is not a tragedy. People calculate too much and think too little. 99% of problems that threaten our civilization come from too optimistic accounting. How about that one? Yeah. This is a great one. Knowing what you don't know is more useful than being brilliant. Couple more. Investing is where you find a few great companies and sit on your but we'll just say, yeah. So that's similar to what you just talked about there. A few people with high IQs are terrible investors because they've got terrible temperaments. Oh, I'm sorry. A lot of people with high IQs are terrible investors because they've got terrible temperaments. It's waiting that helps you as an investor, and a lot of people just can't stand to wait. Necessity never made a good bargain. Two more. I did not intend to get rich. I just wanted to get independent. I just overshot. That's a good one. Last one. It is remarkable how much long-term advantage people like us, he means Warren and him, have gotten by trying to be consistently not stupid instead of trying to be very intelligent. So anyway, there's so many more out there. Those are a few that I noticed over the past week that people shared and some that I've shared before. And what I think is neat, if you peel back the onion on some of those, he's talking psychology. I'm not saying he's a closet technician, but I like to use charts and technicals, momentum. There's a lot of psychology that comes with that. And I'd like to think that maybe Mr. Munger and Warren Buffett are actually closet technicians out there. Anything final on Charlie Munger before we go forward, Sonu?
No, I think the big theme of it is don't do stupid stuff, right?
Yeah.
You don't have to be brilliant. Just don't do stupid stuff, right? And there's some classic investing lessons. You've written about it. I've written about it. Munger's talked about it all his life, and Buffett too. I think, focus on the long term, know what your plan is, and stick to it. I know it's hard, easier said than done, right?
Oh, yeah.
You don't have to be like an IQ of, I don't know, whatever, like 150. No, you don't to be successful.
Yeah. Well, I'm living proof you don't, because trust me, my IQ is not 150, and I have a podcast anyway. But it reminded me of the other. Yeah, exactly. It reminded me of the other Warren Buffett quote, and we need to move forward. But something along the lines of just be average over a long enough time frame, and you will be way above average at the end of the day. Because again, just don't make that big mistake. Some of the best investors I've met doing this for 22 years. You know who they were? They're the people in the crowd that just sat there, and every time we had a pandemic, or not pandemic, wrong word. Every time we had a pandemic or a tech bubble burst or financial crisis or a bear market last year, you know what they did? They just kept investing. Every 2 weeks. I talk to people all the time. Hey, I sold at the bottom here. I sold at the bottom here. I sold at the bottom here. I couldn't take it anymore. What do I do now? I don't have the answers. I don't have any answers for that. It's like, don't sell next time you feel like selling is the answer. But those are some of the best investors I've seen. And I know it sounds so simple in the moment when everything is red and everything's falling apart. But if you've got a long enough time horizon, a decade or two, those are probably going to be major opportunities. And Warren Buffett and Charlie Munger have taught us that. And, he retired. I guess he passed away with about $2 billion. Now, Warren Buffett had well over 100, so I'm not sure the disconnect there. But nonetheless, he probably gave a lot away. Gave most of it away, probably. And I know Warren Buffett's planning on giving 99.99%, I believe, of his earnings as well. So Charlie Munger probably beat him to the punch, so to speak. Just rest in peace, Charlie. Obviously, the neat thing about any of us passing away, believe me, it's a tragedy, but we're out there, right? What Charlie talked about for years, you Google it and you're going to find it real fast. In fact, he just did his first podcast ever. And I forget who it was with, but he just did his first podcast like a month ago. He's never done one. And it's just interesting, the timing of all this. Yeah. So definitely, I might look it up here while you're talking next time where it is, but you should check it out. I did listen to it. It was great. All right. So we've probably got 10 minutes, give or take.
All right.
To talk about things you don't see in a recession. I've got a few, but obviously this is probably more your segment than mine. What are some of the big things that are happening that people maybe just don't realize? Because all we keep hearing about are the same worries, the same concerns. What's happening under the surface that is just saying, listen, there's no recession coming?
I'm going to pick something from your there, which is stock. The Dow is, after including dividends, is at all-time highs. I think that tells you enough, right? I mean, so and what the S&P is very close to it after accounting for dividends. It's 2% away, something like that. I think that tells you enough. That tells you a lot. We just literally talked about markets looking forward, right? Markets are not looking backwards, right? A lot of the economic data can be backwards looking data.
Sure.
I mean, sometimes it tells you what the trend is, and that's why we look at that data. It's important. But stocks are, people are always looking forward. And I think that's as good a sign as any that we are not in a recession right now.
That's well said. I mean, we talked about that briefly, but I think it's important to hammer that home again to the listeners. Stocks tend to lead. You've shared some really cool lead the economy, I should say. You've shared some really cool charts in different blogs on X with our partners and different calls in different ways. On manufacturing, I just think it's fascinating to me, Sonu, the explosion we've seen in manufacturing, construction, kind of high-end technology manufacturing. All I hear about are these ISM data pieces, manufacturing, which keep coming in less than 50, like, I don't know, over a year in a row. I don't even know the number. But the truth is the surveys are saying one thing, but there's some wildly bullish, the right word to use, wildly strong economic data on the other side. You want to talk about that?
That's facts versus feelings. I mean, the feelings are all in the, can I say, like, feelings are in the toilet here? Manufacturing sentiment is concerned. But private companies are spending. Look at where they're putting the money where I don't know, not where their mouth is, because the mouth is saying something else. But,
True.
But look, manufacturing, construction, after adjusting for inflation, right, over the last year is up about 70-80%. I mean, you look at a chart of it and it looks like, one of those .com stocks or something like that, right?
Yeah.
Since the end of 2020, so we're talking about 3 years, 21, 22, 23, manufacturing, construction, so there's construction of factories, things like that, that's up 100% after adjusting for inflation. A lot of it is because there's more semiconductor plants being built, a lot of electric vehicle battery plants being built. That stuff alone is up, Ryan, listeners, 914% over the last 3 years.
Whoa.
914%, which is an incredible, that's my, I mean, I know you can't see the chart over here, but you've shared it, I've shared it. Mm-hmm. That's my chart of the year. I mean, you don't see anything like this. And that's on the non-residential construction side too, right? You take last year, housing was a big drag on the economy. No surprise, that's how monetary policy works. They raise rates. The first thing to get hit is housing. Boom. Housing. Yep. I think it's safe to say they crashed the housing market last year, right? Now, there's a long way to go still. But if you look at construction activity on the residential side, single family homes, multifamily homes, right? That's close to record highs, right? So we are seeing a massive construction boom in America right now, which is, I think, just goes under the radar of all this. Oh my God, what is the Fed going to do? What's going to happen with interest rates, all of that. Look, I'm not saying interest rates being high is not a problem. It is, but we wouldn't see this amount of construction in the U.S., residential and non-residential, if interest rates were that much of a problem and we were close to a recession.
Well said there. Those are some. You share those charts, and they are fascinating. And honestly, you started sharing those charts earlier this year. I know in March when the regional bank crisis was taking hold, and there was a lot of fear and a lot of worry. I mean, go back and look what people were saying. Even the biggest bulls, there were a few bulls that actually were starting to throw in the towel in March, and we're looking around like, oh boy, this could be getting bad. And we hung tough, and that was one of the reasons. And I do want to some housekeeping items before we go forward and talk about a few more things that you don't see in a recession. We have an email now, so you can email us here at the Facts versus Feelings podcast. It's Facts versus Feelings. Versus is VS, Facts versus Feelings, at carsongroup.com. And then again, just want to remind everyone to let you, I don't know what I'm getting at. Yeah, so if you listen to this podcast, feel free and leave a review. We'll just leave it at that. We'll leave it at that. Okay, moving forward now. So I just did a blog, and by the time you listen to this podcast, you probably can find this blog on carsongroup.com. And again, it's kind of the idea of, again, things you don't see in a recession, Sonu. And I know we're getting a little late in the tooth on this podcast, but I just want to point them out here. This is some of your amazing work. Disposable income, employee compensation are both running drastically higher, in some cases above inflation, looking at PCE, looking at the last 3 months, 6 months of 1 year. So believe me, I hear it every day. You do too. Things cost more. Things cost more. They do. They absolutely cost more in a lot of cases. Not everything, but believe me, from 3 years ago, a lot of things cost more. From a year ago, a lot of things cost more. What we hear all the time, though, is that we don't necessarily hear the fact that, you know what? People are actually making more money. Net wealth is near an all-time high. If you look, or at an all-time high, if you look at net wealth relative to debt, we've talked about these things before. Balance sheets are in really good shape. And the truth, again, people have owned houses for many, many years, but just the last 3 years, your house is probably worth a lot more money. You own stocks the whole time. It didn't panic and sell. You're probably worth a lot more money. Maybe you do have more debt out there. But again, balance sheets in corporate America and on households are some of the best that we've ever seen. And it's honestly better than they were pre-pandemic. I know Claudia Assam came on a couple weeks ago and talked about that. She did and I know she I think she drummed up the hornet's nest, but she said, I was right. On Twitter, she did a post called, I was right, talking about some of these concepts. If you haven't listened to that Claudia interview, she's amazing. And I started reading her Substack, and I absolutely think, maybe strongly consider doing that because she's really, really good. So balance sheets are in a lot better place. We mentioned TSA all-time record. You don't see that. Stocks an all-time high. I think I've got one more now. Maybe
consumption's running above trend. I think you have that in there too.
And consumption, that's it. Yeah, the real personal consumption expenditures continuing to run above trend for what is this? Almost 3 years now.
Right?
Yeah, after adjusting for inflation, almost 2.5, 3 years now, stronger than pre-pandemic. So the consumer is still strong. So we've got a few more minutes. What are a couple other things that you can think of off the top of your head that you just don't see in a recession?
Layoffs.
There you go.
Right? Mm-hmm. JOLTS came out. The job opening, it's a mouthful. Job opening and labor turnover survey for October. Look, layoffs are running about 1.6 million. Before the pandemic, it was running about 1.8 million. So it's like, look, there's a lot of churn in the economy, and every month it's, like 1.6 million people getting laid off is a big number, right? But of course, a lot of them are getting, a lot more people are getting jobs, all of that. And you have to sort of normalize it because we do have a larger labor force than we did 4 years back, right? Before the pandemic. So if you normalize that, we have something called the layoff rate, right? It's a number of layoffs divided by the total employed workforce, right? That's running at 1%, Ryan, right now. Before the pandemic, it was running about 1.2 to 1.3%. Wow. You don't see, such a low. Not even low. Low is an understatement. This is incredibly low, the level of layoffs right now. And that just shows the strength in the labor market, which gets to the strength in the economy. Remember, the other side is, you talked about real consumption, real incomes, going up. The story here is inflation's coming down. The labor market is strong. So there's a lot of wage growth. There's a lot of incomes in the economy. And that's driving consumption. That's driving the economy. That's driving profits.
Mm-hmm. Yeah. Wow.
That's the story.
I think we just summarized our view of the world, right? We are putting the finishing touches on our 2024 outlook. Sonu just gave away some of our views. But if you listen to this podcast every week, you probably have a clue as to how we see the world when our outlook's going to come out in a few weeks. But bottom line, again, this was episode 63 of Carson's Facts versus Feelings with Ryan and Sonu. We titled it Things You Don't See in a Recession. So Sonu and I will be back next week. And we have a really cool podcast in 2 weeks with Ed Clissold over at Ned Davis Research. I saw they just released their outlook for next year. So we're going to have a lot of fun discussing. We're huge fans of Ned Davis in general and Ed's work. So that'll be a really, really good one in 2 weeks. But next week we'll be back for just a regularly scheduled podcast. With all that, everyone, thank you again for listening. A lot of fearful stuff out there, but hopefully we continue to show why there are some really good things happening as well, and why we just simply do not see the likelihood of a recession anytime soon, and likely in 2024 as well, which is an election year, which is going to scare everybody. We'll talk about that next time, though. We'll see everybody next time. Take care. Goodbye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.